Hello everyone. Welcome to the world of corporate finance. Today we are discussing very important topic that is capital asset pricing model. So before going with the numericals, let me clear what exactly this model means. When we as an investor, when we do investment in a particular asset, or when we do an investment in a particular stock, we are using this model to measure the risk which is associated with that particular portfolio or that particular asset, and based on that we can expect how much returns we will get from that investment. In capital asset pricing model, we do have a simple formula. We called it as a expected returns is equals to risk free rate plus beta multiplied by market risk premium. Now what exactly market risk premium means? Market risk premium, it is a difference between the market returns and the risk free rate. So, as already in the previous sessions, we covered how this capital asset pricing model works, what is the SML, what is the CML, then how different ratios were there, which will be helping us to understand the risk and returns. But anyhow, there are few assumptions which were there in the capital asset pricing model, and based on that, this model will give you an outline whenever as an investor we do an investment in a particular stock. So simply we'll understand this with one example. Say for example, as an investor, if I have 1 lakh rupees for investment, and I do have an option of investing that in stock A, stock B, and stock C. Now all these stocks are of different companies. So where I should invest and how much risk is associated with my investment, and based on that, how these stocks will give me the return. So I have an option of investing whole 1 lakh rupees in stock A, or I can diversify my investment, some amount in stock A, like say for example 50,000 in stock A, 30,000 in stock B, and 20,000 in stock C. So I can diversify my portfolio. So portfolio is a combination of different types of funds. Now, when we use this model to take the decision whether I should invest in that or not, so we need to calculate first the expected returns. Where very important point which comes here in the discussion, that is what the beta value. Now, beta, it is a measurement tool, the risk which is associated with a particular investment. Generally, the beta value is 1. Why it is 1? If your beta is greater than 1, your investment is high risky. If your beta is less than 1, your investment is less risky. So the market phenomena says that if your beta is greater than 1, there is high risk. Generally, when there is a high risk, there will be high returns. And vice versa, if your beta is less than 1, there will be a less risk and you will be getting a less returns. So we do have less risk, less return, moderate risk, moderate returns, and high risk, high returns. Based on this, now we'll go with the numerical. So first we'll discuss what exactly that numerical, and based on that we'll do the calculations, and then we'll see the conclusion part of it. So there is a problem of Apple Incorporations, that is AAPL, a stock of Apple Incorporation which is traded on Nasdaq, which has a beta value of 2.8. Now already I told you what exactly beta means. If it is greater than 1, it means that it is high risk. So here in the given numerical, it was 2.8, which means that there is a high risk. At the same time, the current risk-free rate is 4.5%, which is very less, and which is calculated on the basis of 10 years US Treasury bonds. And the average US market risk premium is 6.2. Now, what is market risk premium? It is the difference between market returns and the risk-free rate. Already risk-free rate is given as 4.5 and your risk premium is 6.2. So if we do the addition of these, the total market return is 10.7. That is 4.5 plus 6.2, which is 10.7 is the market returns minus risk premium. That is what? Minus risk free rate, that is 4.5, you will get market risk premium. Now this is the given details. Based on this, now you need to calculate the expected rate of return using the capital asset pricing model. And there is second question which is asked that suppose if the beta drops to 1.3, earlier it was 2.8, now if it falls to 1.3, then what will happen with the expected returns, and you need to justify whether the stock becomes less risky or that investment becomes less risky or the risk is high. As there will be a high risk, we called it as a high volatility, and if low risk is there, we called it as a low volatility. Now we'll go with the solution of this particular problem. I hope you have clear with the numerical first. Now first we'll understand what they have provided us like a given data. So in given data, we do have a company called as Apple Incorporations. Initial beta, which is given, that is beta 1 is given 2.8. And in question number 2, they mention that if beta falls to 1.3, that is what the B. If beta drops to 1.3, what will happen with the expected returns? And they have given risk-free rate, that is RF, which is 4.5, and market risk premium, that is RM minus RF. I already told you that RM is market return and RF is risk-free rate. RM that we can very easily calculate, RM is equals to market risk premium plus RF, that is 6.2 plus 4.5, you will get market return, that is 10.7. So these are the given details in the numerical. Based on that, if we put these values in the formula of capital asset pricing model, we'll get the expected returns for first case, and then same we will apply by changing the beta value from 2.8 to 1.3, and then we can calculate the expected returns, and then we'll see how it affect the overall expected returns, and then we can justify and we can conclude the numerical. So this is the formula of capital asset pricing model, that is expected return is equals to RF in plus beta into RM minus RF, where RF stands for risk-free rate, beta stands for the volatility or risk which is associated with that investment, and RM minus RF is the market risk premium. RM stands for market returns and RF stands for risk-free rate. And the difference between these two is what the risk market risk premium. Now we'll put these values in case 1. We need to calculate the expected return when the beta is 2.8. So if we put the values ER1, that is expected return for first case, 4.5 is the risk-free rate plus 2.8 is the beta, multiplied by the risk premium, that is 6.2. If we calculate that, very easily we'll get the answer, that is 21.86%. Now this is when the beta is 2.8. As we all know that if beta is higher, that is if it is greater than 1, there will be a higher risk, and at the same time there will be a higher returns. Now we'll check if this beta falls to 1.3, that is the case B. Now if the beta is 1.3, what will be the effect of that on the expected return? So ER2 RF, that is 4.5, risk-free rate is always there, plus 1.3 is the beta. Now it changes from 2.8 to 1.3, multiplied by the market risk premium, that is 6.2. If we do the calculations, we can get 4.5 plus 8.06, which is equals to 12.56. Now if we compare beta 1, that is answer 1 with answer 2, when beta was 2.8, our returns are 21.86, and when the beta falls to 1.3, the expected returns also falls to 12.56. Now based on this, now we can justify what exactly happened. So beta, which is a measure of systematic risk, how much the stock moves in relations to the market. When the beta was 2.8, the stock is high volatile, that is high riskier, and it is more sensitive to the market changes. If there will be up and downs in the market, then there will be a high volatility, and based on that the returns might be vary. So it is riskier. And when that beta drops to 1.3, the stock becomes significantly less sensitive, because sensitivity is something we called it as a volatility. So the risk is reduced, market volatility is reduced, and based on that based on that, the expected returns also falls. That is, the expected returns also drops from 21.86% to 12.56% as the investors require a lower returns for the reduced risk. So that is the market phenomenon. Based on that, now this justification has came. So now concluding this particular numerical, the stock becomes a less risky investment as its beta declines. So lower beta means lower volatility and more predictable performance compared to the market. So this aligns with the lower expected returns, which compensates for the lower risk. So I hope you understand how this capital asset pricing model works with this particular example. Thank you. We'll see the remaining numericals in next session.